Hey y'all, welcome to the Winning at Life podcast with Gregory Ricks. Oh, by the way, I am Gregory Ricks. How you been? I'm so excited about today's episode. Some of my favorite money we're going to talk about. Do you have a favorite type of money, or you just like money? Well, I do too. But what I really like is tax-free money. And tax-free money that grows more tax-free money. So I believe everyone should have more of that. So we're going to talk about that today and how to get more of that. I have Mason Goynes here with us today to talk about it. Before I get him started with us, because he's going to run with it, I'll tell you that. He loves him some Roth money. But he was recently on the podcast talking about IRA rollovers. So go to our YouTube channel and check out that episode. There was some really good nuggets in there to help you grow your money and make some great decisions and avoid pitfalls, as there are. It can be some scary things happen, and people sometimes mess it up and create themselves taxable events, like all of a sudden a check just shows up in your mailbox with taxes deducted. So we talked about how to fix that in that episode as well. Now, I also want to remember this show's not possible without a bunch of people helping out. So first, some of our show sponsors: Dwayne Stein of MortgageGumbo.com, Jude Heath of J. Heath Company CPAs, Wesley Blanchard of W.J. Blanchard Law, FirstFarmCredit.com, Pat Huber over there is another sponsor. I was being asked about one of our sponsors, like, who is this JJSAudioVideo.com? Well, it's a dude that's pretty good with setting up video cameras, sound systems, wiring your house, stuff like that for audio, video. And heck, he's done work for me over the past 20 years. His number is 504-638-0906. Gregory Ricks and Associates. Gregory Ricks Total Wealth is a sponsor of the show as well. So it wouldn't be possible without them. And another one, because there's something I dislike besides taxes, and that's mosquitoes. So neworleans.mosquitojoe.com, and tell them Gregory sent you as well. And what would be really cool, get all your neighbors to do that, and you can kind of form a pod protected of mosquitoes. That's my theory about it. And one other is this wouldn't be possible without iHeartMedia as well. So want to give a shout out to all of those sponsors as well. Let me see. Oh, I was just notified you forgot an important one. .com. It's did I even do that right? Dwayne Stein of MortgageGumbo.com. I thought I had mentioned him, or maybe I just mentioned his name. I don't know, but I got reminded of that. One of my producers here, like, throwing stuff at me. Did you see me dodging something there? Yeah, it almost hit me. Okay, Mason, you ready?
Ready.
I know I've delayed it. Now we can really get going on this. So talk to me about Roth conversions.
Yeah, so a lot of things to unpack there that we'll get into, but essentially a Roth conversion is what it sounds like. You have some pre-tax money out there. You don't want it to be, you want it to grow, kind of like you said, the good stuff, tax-free. And there's a way to convert those funds from pre-tax, crossing that tax barrier, into a Roth IRA or a Roth account, and Roth dollars are very valuable. They grow tax-free in the future.
Great. So how do we get started? What are some fundamentals rules about Roth money? I hear talk about the clock.
Yep, there's a 5-year clock, and so money has to be in this account for a period of 5 years before it gets that special tax treatment if you're contributing to a Roth, right, there's two ways to get money into Roth accounts. It's contributions and conversions. And conversions is the tricky one we're going to talk about today, but contributing funds over time, you can always take your money out penalty-free, tax-free, but the earnings and growth and all that we were talking about, there's a clock that's tied to it, and an age requirement for 59 and a half.
Yeah, so thinking about that clock, and one of the things, if you're young and contributing, obviously you've got to leave that money there to 59 and a half. There's some exceptions. You can get money out of it for school. You can get money out of it for first-time home buyer. But for it to be used for that tax-free distributions beyond 59 and a half, it has to have been there 5 years.
Right.
It doesn't mean every contribution, the account has to be established for 5 years. So you'll hear sometimes just open an account and put some money in it to get the clock started. Now, rollovers are a little bit different animal in that, and that is something we would dig in deeper at another time, and that's situational there. But you got to be cognizant of rollovers too, right, and that 5-year clock. I know it sounds like a big deal. It really isn't, but that's one reason I'll tell somebody, well, do you have a Roth account? Well, we at least got to get one open and get started, because if you stick around us, you're going to have more money in that account. It's such a great thing. Here's one of the things, and I'm going to jump ahead to the 10-year rule and beneficiary concerns. It's the one that really stands out most to me, and one reason to do so. We do talk to our clients about Roth conversions, moving some money. It doesn't mean we try to convert it all. Not a bad idea, but can come with a pretty big tax bill. But I also think for most people, there are windows that give you a really good opportunity. And a lot of times that window is right at the beginning of retirement, where you have that window and opportunity there before you really get into the distribution of money. And you're not doing RMDs yet as well, required minimum distributions. Got to be careful with the acronyms, because you and we kind of been doing this a long time.
Right.
But required minimum distributions can impact conversions, because the Roth conversion can't count for an required minimum distribution. But I think there's a window there to start shifting some money. And one thing I always like to talk about is compounding money. I just kind of like, hey, I'd like to see if we could shift 100,000 of your money. You know, that might seem like a lot, but if we do it over 3 years, it's 33,100 thousand there. So if you do it for 3 years, and let's say you're at 67, let's do it different. Let's change the math. Let's say you're at 57, and we do it for 3 years, and it's $100,000. I'd also like you to pay the taxes outside of that. We could use that money to pay taxes, but that's not as efficient, because that's special money. So now we've got 100,000 converted, and you're at age 60 at a 7.2% return. You know where I'm going with this? In 10 years, that 100,000 is going to go to 200,000. Did you add any more money to it? Did you convert any more? No. And that takes you to 70. You've now got 200,000. In 10 years, that 200,000 now goes to what? 400,000. How old are you? 80. Well, you're going to live to 90. So now it's going to be 800,000. When you die and leave it to your kids that are up in their high earnings age, how much money are they going to pay on that Roth money they inherit?
Zero.
Yeah. When you left it to them, do they have to take it out right away?
Not right away. They have a 10-year clock for most beneficiaries that they have to take it out.
Yeah. Which means that 800,000, they can let it idle to $1.6 million. What about a gift? And I know you've got hundreds of thousands of dollars, but all we did was convert 100,000 to do that. It can be almost painless. That's the Roth story I like to float whenever I speak publicly about the topic. So, and I think that's important, but that what we're going talk about the 10-year rule and the beneficiary concerns, which is why I brought that idea up.
So there used to be something called the stretch rule, the stretch IRA that you might hear about, and in the past, pre-2019, 2020, before that legislation came out, your beneficiaries would receive your IRA, pre-tax or post-tax, and they could actually stretch it over their lifetime in certain situations, right? Well, that's changed now, and if you are it's usually made for descendants, right? So next in line, if you have a beneficiary that's within 10 years of or a spouse or a beneficiary that's within 10 years of your lifespan, they're not subject to the 10-year rule, but kids, grandkids, if it goes down the line there, they have to take out that money within 10 years. And if it's pre-tax money and your kids are doing well for themselves, right, they could be in a tax pickle for sure. And if they do let that money go,
their highest income of period of life is when they're probably inheriting that from you.
Yeah, and it grows kind of like you said, that compounding story. If it's not growing in a tax-free manner, well, year 10, if that money's not out of that account, you're going to take it all in that year, and depending on what that could be 40% of it going to the government, right? And that's not what you're playing for.
Yeah, and once again, the traditional 401k, the non-Roth 401k, the traditional 401k is when you die, and you're we'll just call it post 72. Mm-hmm. They have to take RMDs from it. And there's a formula for it, but here's what we're getting at is they probably should be doing averaging to liquidate it evenly over the 10 years, because they could take just the required minimum distribution, but at year 10, that traditional account has to be emptied,
right,
which creates a giant tax bill. If it's a Roth, there's no RMDs. And they don't have to take any distributions, and they can wait to the 10th year to empty that account.
And that takes some proactivity there, right? You don't want to just let things go or be reactive, right? You want to kind of have control of when that money's taxed and how it's left to your beneficiaries.
So we kind of talked on theory about shifting 100,000. For some people, it might be 10, it might be 50. There's other situations where folks have done it all over a period of time. And we can walk you through the different strategies that will work for you. One important thing about that, because back in the day, you could do a Roth conversion and you could change your mind. You can't do that anymore.
Right.
So just to be clear, we will walk you through that. We'll walk you through the tax consequences and the planning for that to make sure that works for you. But there is a great benefit to creating tax-free income in the future. And, we had a situation where taxes didn't go up when we thought they might. They updated the law, protect us from increased taxes, but I still see the government spending more than they take in.
Right.
And they always have a plan for us on taxing more. And you hear that on the news. There's somebody somewhere always wanting to tax the rich. That's you, is who they're talking about. They disguise it as, well, we're going to get more out the billionaires. No, they're talking about you as well.
That's who pays the majority of the taxes in the country. And you're right, the uncertainty of future laws are something that we can project, we can assume, but we have the knowledge we know now. We can take, like you said, some proactive measures to make sure that those potential increases in taxes don't come back to bite you.
Yeah, I saw you actually had talked in your notes you gave me, is, hey, make sure we touch on the tax legislation. So I of the future. So I kind of stumbled right into that. Any thoughts on when it makes sense versus to avoid?
Yeah. So there's opportune times to convert to Roth, and then I mean we always say go for it, but it could be tricky, and then there's times to avoid it, right? So maybe when it makes sense, if you're timing it, we want to do it on a strategic basis after kind of the end of the year makes sense sometimes after exactly what your tax situation is, but it can make sense either, if you're in a lower tax bracket and you expect taxes to go up, or when markets are low. When we have a little dip in the market sometimes, that could be a time to pounce or look at what it makes sense, because you'd be converting money and buying at a low, and then when the bounce back comes, that growth is tax-free. And so that's kind of when it makes sense to do it. When it makes sense to avoid it, if you are retiring in a lower tax bracket, which often isn't the case like people think, but if you're retiring and your tax bracket's going to be lower, then it doesn't quite make sense to pay at a current higher tax bracket now to convert those funds when you're just going to take it out in a lower bracket. And then if you convert to something to watch out for, it can bump you in. You said that window of time is really important, because that's pre-Social Security sometimes and pre-Medicare premiums that can increase. That can come back to bite you too.
IRMA. You can impact IRMA. So those are all the things we look at. Look for what the pitfalls and so forth are from that. And here's another rule I kind of have. I hate wasting tax bracket space, that margin. So it's kind of like when you look at where you're projected to be towards the end of the year on income, how much gap do you have in bracket? If you kind of say, well, I got $10,000 before I hit of income where I hit the next tax bracket. Well, darn, that's Roth opportunity right there, because if you let it go, you don't get that chance to do that again without moving into another bracket for taxes from that standpoint. So that's something we look at as well. So we talked about the 10-year rule, uncertainty of tax legislation. Give me the case study example on the book Power of Zero.
Yeah, so really interesting book, The Power of Zero. If anybody ever picked it up and read it, it's essentially trying to tell you that, like you said, the best money is tax-free money, and it has a few strategies in there to make sure you plan the way you need to get those to get those tax benefits from converting. But kind of a case study that we had recently was some folks came in, and the Power of Zero book mentions it too. There's actually an optimal amount of funds not to convert, right? If you convert too much and bump yourself into a higher tax bracket in the beginning, and then you got no more RMDs or no more money in the future, and you're in a 12% tax bracket, well, maybe you shouldn't have converted so much, because now you're in the 12% tax bracket. It'd be really nice to take out some IRA distributions in that tax bracket. And conversely, if you don't do anything, those RMDs and Social Security, all those pile up at the end, and taxes might be higher, and you're in a future higher tax bracket. And so those kinds of things, it's kind of a balance. It's kind of a balance, just converting enough to make sure the tax liability isn't impacting your future.
I was thinking there about the Medicare premiums again, IRMA, driving up those. It was like, well, why does my premium keep going? Well, your income keeps going up.
Right. And it's a 2-year look back on those. And what I mean by that, and some folks know it if you've experienced it, but some don't. If you retire, there's a look back period of 2 years on what your income is. That's what's going to base your Medicare premium rate on.
Yeah, it takes... It's funny. It takes the IRS 2 years to walk your tax return across the street to the Social Security office there.
That's right.
It's like, oh my gosh, but it's what you did. What you're doing today can affect your Medicare premiums 2 years in the future is always a way to think about that.
Absolutely right. Absolutely right. And that's stuff that we look at in our planning and things that we do. In that case study I mentioned, it actually made sense. They had so much pre-tax money that it made sense not to do everything, do heavy conversions, and keep them in a steady, what we hope is 22, 24% tax bracket for the long period of time, rather than paying 30% now and 10% later, or 10% now and 30% later, right? The math came out to be equalizing that. And the biggest thing we kind of touched on that window was the uncertainty of tax law. You mentioned, taxes going up, government spending a lot of money. That's something that we feel pretty strongly is not gonna go away. Historically, we're in some of the lowest tax rates we've seen. Whether you feel that or not, it is the truth. And so making sure that you're planning for those eventualities makes a lot of sense.
That is some really good stuff. Any other thought? Anything I missed asking you a question about?
I don't think so. The process is good. It's a simple enough process to get money from traditional to IRA. It's just a journal of the account, and you can do that. But there's a lot of consequences, like we just said, that come with it. So just don't do it flippantly. You need to plan.
Yeah, and there's a topic I have here: how to use a mega backdoor Roth for maximum tax-free retirement benefits. We're going to talk about that on an upcoming episode. I'm probably mean by kind of mentioning that out there, but it's just tax-free income in the future is pretty powerful. Doesn't mean you can shift all of it, but you should make a dent in it and thinking about that way. We've had clients that just chip away at it year after year. I've had clients where over a few years they managed to convert substantial, if not all of it. And some kind of like, yeah, I'm good after converting 100,000. Everybody's situation is different, and we walk you through that. And each year on your strategy visit, we talk about this strategy and where you're at and where you're going. I always like to look 5, 10, 15 years out to how it's going and when people used to call that reviews, and the review is easy. It takes a minute to see where have we been the past year. We want to spend more time on what do we see coming, what adjustments are we making the next few years, and how does 5, 10, 15 years out look like. And then that money on the back end, is there going to be money for back end events? So we want to have those discussions, and you have to always keep talking about those and be pre-active. Have I missed anything on that, Mason?
Nope, that was perfect. Very, very important.
Awesome. Well, we appreciate you joining us here today. We are going to have new episodes of the Winning at Life podcast that come out every Wednesday at 3. You can also reach us on Saturdays, Winning at Life on iHeartRadio. So you can catch that as well. Check out our YouTube channel, sign up, become a member of that. And let's see, what else do I have? Here, I'm going to throw this out to you. I've done this on a recent podcast. 5 things to do with your old 401k. Don't leave that money sitting around and forget about it. Go to GregoryRicks.com/401k and let's get that money to work for you. Reach out to our sponsors that I spoke about earlier. Our website is GregoryRicks.com. Email is info@GregoryRicks.com. We are Gregory Ricks Total Wealth.